Hello and welcome to episode 158 of the Money to the Masses podcast with your resident expert as always, Damien Fay, and me, Andy Leaks. Damien, welcome back. How the devil are you?
Good, Andy. I'm very good. We're actually recording the podcast slightly earlier this week, so we are so organised. It makes a change, doesn't it, from our 11th hour attempts at getting the podcast out to everybody. But yeah, I'm good. Feeling very organised. So we actually only spoke to each other, it feels like a day or two ago. But not much has changed in the interim. How about you?
Yeah, exactly that. I think the listeners will be pleased to know that, we've already done the catch-up, so we'll be getting straight into it this week. What have we got on this week's podcast?
Well, on this week's podcast, there are three pieces I wanted to cover. One of them is in relation to private medical insurance. And it's not a topic we haven't, I'm not sure if we've ever spoken about it on the podcast, but there's things that people should be aware of about private medical insurance, and in particular, the small print that has caught many a person out. I also want to talk about charity gifts. Now, it is near Christmas, and people like to do sort of charitable things. And this has got something actually to do with my week as well, so we'll link on to that. But yeah, so I'm going to talk about possible charitable gifts that people could buy for this season of giving. And the last one I just want to quickly touch upon is an investment piece that has been inspired by some bits and pieces I've been doing with 80/20 Investor. But it's really just in relation to the technology stocks out there, the tech stocks that have absolutely flown out the traps this year. So the likes of Facebook and everybody. In recent weeks, we've had a couple of spates of sell-offs in those areas, and there's certain things you can learn from that. I just wanted to talk people through because it's quite interesting.
Good. What should we start with?
What do you reckon, Andy? You pick.
Oh, I don't know. I genuinely don't know, Damien.
I think you weren't even listening to what I said. So let's go in the order that I said them. So private medical insurance.
I most definitely was. Don't you dare ever accuse me of that. Let's go.
Andy's looking very festive, by the way. He's got his Santa hat on, which I very approve of, and we both agree actually that Andy suits a hat, even if it is a festive hat. So it does suit him. Maybe we should put a picture out at some point of you. But yeah, private medical insurance. Now, there was a piece that was run in one of the national newspapers. I think it was the Telegraph, actually, recently that I saw. And it was highlighting the plight of a gentleman who had become unwell, and he had private medical insurance. Now, those who don't know, private medical insurance, I know we've got the NHS, which has got its good and bad points, but obviously there are people out there who pay an insurance premium to be able to have certain things covered so they could go to a private hospital to have treatments. And it's quite expensive, that's the big drawback of it, but obviously the care is presumably better and you can get skipped queue times. And I know for a fact that there are many people in the NHS, many surgeons and consultants who do their private work, and actually you could be waiting months to see them, and if you put it through your private medical insurance, then you can see them the next day. That's just the crazy world we're in. So there are lots of employers that provide it as a benefit, and this particular chap ended up being out of pocket to the tune of £130,000 because of the small print on his private medical insurance policy. So what happened to him? Well, this gentleman became unwell, and it escapes me what actually happened to him.
Damien, sorry, I think you made a mistake there. You said
£130,000. It did. I definitely didn't. It was £130,000 it cost him.
Okay, as you were.
It's an incredible amount of money, which is why it made one of the national newspapers. And this guy, he wasn't young. He was an elderly guy, and what happened is that there was it escapes me what the condition. Something happened to him, and he ended up having to have an emergency care in the hospital. He was taken in, and it was in a private hospital, and then after that he was taken from that private hospital and then out of the sort of intensive care area, etc. And then he was then treated for the underlying condition that had caused him to be there in the first place. So he assumed that his insurance would foot the bill from the private hospital because he thought it was under his private medical insurance. But there is a common exclusion on private medical insurance policies, is that emergency treatment isn't covered almost as standard. So, because even though he was ultimately going to be having treatment for this condition, that the fact that he ended up going in, it being treated under an emergency procedure, actually meant that it triggered this exclusion on his policy. So the bills were racking up at a steady rate, even though when he came off of emergency treatment and was back on a more like a ward being treated for his condition, the bills went up to £130,000, and now the insurance company refused to pay out the money. And it went to, eventually the complaint went to the ombudsman, the financial ombudsman, and the financial ombudsman actually decided in the favour of the insurance company, because they said that that was actually fair, that the cover always would exclude emergency procedures. Now, there's a key point on this that I wanted people to really pick up upon. If you ever have private medical insurance, if it's like through work or you have it yourself, by just a general rule, it only ever will pay out if it's either for pre-planned care, so something that was a procedure that has been planned and scheduled to happen, and it was pre-authorised by the insurance company that they would pay for it. You can't suddenly just have a treatment and then go, right, I'm going to make a claim. You need to pre-authorise it. That's kind of the standard process. Now, the stats suggest that in the private medical insurance is actually becoming more and more unpopular now because of the sheer cost of it. The prices have gone up on average 10% a year. That's the premiums, 10% per annum, and that's over the last 20 years. So the average is 10% a year, and about 200,000 people have cancelled private medical insurance policies in the last 3 years. So if you're thinking of taking one, just make sure you understand some of the exclusions in the small print. And one or two others I just want to point out to people is that pre-existing medical conditions are generally excluded. So you just use me as an example, my Crohn's disease. If I took out private medical insurance, it generally they would likely exclude it as a condition. So I then became ill, they wouldn't pay out. Now, there are two types of private medical insurance you can get when you take a policy out. They can underwrite it, so they get the underwriters are the guys who assess what sort of risk you are. You can have a fully underwritten policy where they look at your inside leg measurement and all your medical history and decide whether they're going to cover you, and if they are, for what things. So for me, for example, they would run for the hills with regards to Crohn's disease. They might cover me for, at least I can laugh about it. They might cover me for other things, but the chances are they wouldn't cover me for Crohn's disease. But there are other forms. There are some companies that offer something called a moratorium type of policy, where rather than they underwrite everything, they take you on board, but they won't cover any pre-existing conditions, let's say in the last 2 years or the last 5 years. Anything that's happened in that period won't be covered under the policy for a particular period of time. And some of them will even go as far as to say, if you took out a policy with a moratorium on it, if I was lucky, let's say, and they said, yeah, of course, Damien, we'll take you on and don't worry about your medical conditions. Your Crohn's, if you don't make a claim for 2 years at all, and you're perfectly fine, there's no problems with your health related to your Crohn's, then it will become part of the policy. That's a possibility as well. And so that will all impact the price. So there are different versions of private medical insurance. So it's just a bit of an FYI to people, that to be aware what they have with their company, because like I say, typically it's through a company. The other thing to bear in mind is that they tend to exclude longer term treatment. So if there's something like you were having some issues where you had to have dialysis, they might not pay for treatment like that. That would have to go on for a long time. They certainly won't cover pregnancy. So I know that's not a medical condition, but if you were pregnant, and you're not going to get any sort of treatments under being pregnant on a private medical policy. So
that's right. From my understanding, it's sort of chronic conditions that require ongoing treatment. So you might get the initial diagnosis and maybe the first 1 or 2 sessions, or maybe if you needed some follow-on treatment. But if it needed to continue on, the likelihood is you'd be referred straight back to the NHS. I mean, check your conditions on that. But I do know a couple of people that have had the first bit covered, but then, ongoing treatment isn't covered.
Yeah.
So you must take care.
Yeah, because Andy actually, people might not know, but Andy's background is in insurance. Andy is a bit of an expert when it comes to medical insurance, life insurance, these sorts of things, even though he doesn't necessarily talk about it on the podcast. So listen to what Andy's saying. And the other thing to bear in mind, when you listen to all of this, and it's the problem I think of the industry has, is that the policies are very complicated. The policies are very heavy with T's and C's and possible exclusions. The number of complaints about private medical insurance to the financial ombudsman have gone up 50% even in the last year. So I think there's private medical insurance, other types of insurance that we've talked about previously, like critical illness cover. I think there needs to be a lot of work done by the insurance industry to make them easy to understand and accessible to people. But one final thing before I move on from private medical insurance, that if you are, for example, working for a company and you get it as part of your group benefit, so that what they do is it might be discounted because they cover 100 people who work in your office or something like that, so it actually makes the premiums cheaper. They're less bothered about you as individuals. Then it may be, if you go to leave an employer and it happens to be a particularly good scheme or something like that, it is worth asking before you leave whether there's anything you could do if you want to be able to take on the premiums yourself and pay for it as an individual, because obviously if you've served a period of time with a moratorium and stuff like that, then I just know somebody who has done this, and it became obviously something they had to pay for themselves, and it was expensive, but it did mean they didn't have to start from square one, and for their own health reasons that was a very good idea. So it's just a passing comment there, but there you go, private medical insurance.
I've got just a touch to add on to that in terms of paying for premiums and stuff. We've had, through my work, I run the payroll at my company, and through my work there has been some constant confusion over the cost of the cover and the fact that it's not truly free. So just to remind people, if they're thinking of taking cover out through their insurance company, it's generally what they call a benefit in kind, which means that you might not pay for the premium, might not pay for it out of your salary, but likely you will often have to pay the tax on it, and it will go on to what's called your P11D form. So just something to look out for. Some companies it might be slightly different, but most companies will have it as what they call a benefit in kind, which will go on to your P11D. It essentially affects your tax-free benefit, and it may mean that your tax code is changed so that you end up paying the tax on the premiums. It might be a bit techie there, but just be aware of it. Some people think it's totally free. Sometimes you just need to be aware that actually the true cost is around about, if you're a lower tax rate payer, around about 20% of the total annual premiums you'll end up paying yourself. Is that too technical?
No, I think that's spot on, because that's a great piece of information, because that's the sort of thing, if somebody sees their tax code change, they might wonder why. And I've worked for companies before where things have changed, like what you've just said, and you've tried to understand what's going on, and you've gone to the accounts people and they couldn't explain it. Or there's been instances where people have had benefits in kind, I know, that weren't taxed properly and they didn't realise, and the taxman's come after them and fined them personally. And that's the sort of thing that I think is a great tip, because it's one of those things that if somebody has that, they should be looking out to see that it's being worked out appropriately in their payroll.
Just a final bit on that, the real unfortunate point of it, a lot of the time with benefits in kind, companies have to declare them the following April, so often you're paying for these benefits in kind almost 12 months behind. So just to be aware of that, again, it can be quite frustrating. You think, oh, that was last year, surely I've paid for that. Often the way that HMRC work it and the way that they ask for the information, you're often paying catch up 12 months behind. So yeah, just be aware of that. Good, right, enough of health stuff. Let's move on to something slightly closer to my heart. Don't like to talk about it, obviously. Charities, Damien. What do we got?
Well, this is a piece that... Funny you say that, Andy, about talking about it. And in the offices, we've been discussing about charity, because people don't realise, I've never, ever, ever spoken about it until now. That is that we, behind the scenes, we are doing things for charity to try and support charities. So what we do is we're going to sit down and we work out the charities that we want to support. And I mean, I will give more information on that in the future, because somebody said to me, I was of the opinion, you don't talk about it, but then somebody quite rightly said, no, I think if you do something, there's nothing wrong about being proud about something that you've built to help other people, like in terms of learning about money and their own finances, but also the fact that it helps other people in different ways, whether it's homeless people, etc. So something we'll come on to at a later date. But while we were thinking about the charity angle, I thought it would make a good piece to talk about the potential gifts and things you can do at charity. Because what happens at Christmas, there are lots of charities out there and people start thinking about maybe giving a gift to a local charity for children or something like that. And I just want to mention four campaigns that are being run that this time of year, so it's Christmas at the moment, but this time of year, that are very specific for charities where they would be greatly appreciated. And the first one I want to talk about is booktrust.org.uk. Now, they do their campaign is that you can donate £10 to their campaign, and they use it to buy books for children in care. And so a lot of children in care never have a book, and to be able to give children the gift of a book, their first book, or be able to read and that sort of thing, I think is wonderful, and obviously it'd be greatly appreciated. So if that's one of the gifts you could do if you wanted to donate some money, it's only a small amount, and these sorts of things are small amounts of money that can make a big difference. And another thing that inspired this, it was somebody, I was seeing some things on social media about people doing certain charitable things, and they were wondering whether people actually needed that. And there were lots of charities like the ones I mentioned that they don't have as big a reach or marketing, that people don't realise that they'd be greatly appreciated. So the next one is refuge.org.uk. Now, this is to do with the Women's Refuge. So if you don't know what the Women's Refuge is, unfortunately when people are the victims of domestic violence, then there are refuges, so there are houses that are out there that women can go to, flee to, with their children to hide from their abusive partner. And when they go there, they can then get help. They might get help from a solicitor and be able to get back on their feet, but also it's just for their own safety. And it's an amazing organisation and what the work these people do. And this particular campaign, if you go to that website and they have a tab which says Get Involved, if you click on that, one of the campaigns they're doing for this time of year is you can go and buy particular items. So there's like a list of items that are on there. So for example, it might be toys, and there'll be certain toys listed that could be £5-10. There could be things for babies. There's even things as much as a pram, because don't forget, some of these people are fleeing without anything. So they can't take anything with them because they're in fear of their own safety and those of their children. So the children don't have toys and things. So you can go and donate money and purchase these things, which therefore can receive a home at these refuges. Which I think that's wonderful. I think it's a lovely idea. And I knew a family member of mine used to be involved in helping some of the stuff at these refuges. And it's incredibly sad, the story behind it. So this is a great uplifting thing to do. Do you remember Crack and Cider, Andy?
I do indeed. We did a podcast about what was her name now?
Scarlett,
that's right. We did a lovely podcast, and it was very inspiring.
Yeah, so if you haven't heard about crackandcider.com, then go and listen to the One Giant Leap podcast series. You can find it on iTunes, where I interviewed a whole bunch of people doing amazing things, but just off their own back. And it was the series was actually aimed at trying to inspire people to take that leap to follow their passion. And this Scarlett's was that she wanted to help homeless people, and she came up with a wonderful idea whereby, a bit like the refuge idea that I just spoke about, what her pop-up internet shop, and there was some physical shops, but she created a brand called Crack and Cider, which came from a homeless person telling her that people don't donate money to because they think he's going to spend the money on crack and cider. So she created basically a brand, and what you can do is you can go to that website and you can buy products. So you could buy a set of hat, gloves and socks, a set for £7.50 that they will then go and take and donate and give it to a homeless person. So it's a direct transformation of your money into physical things that homeless people need. And if you read their website, it's incredibly interesting. Like, one of the things that just isn't donated that homeless people need are socks. especially in the winter. And so I think it's a wonderful charity. I think she's brilliant. She's one of the most amazing people I've met. She's like, for a young woman to be doing something. She does lots of talks now. So go and follow her on Twitter as well, because it's well worth it. So that's a particular favourite of mine, because I think it's taken technology, a skill set that she had, which was in advertising, combining it with a bit of sort of get up and go, and she's created this brand. And I know it won't solve all the homeless people's problems by giving them hats, socks and warm clothes for the winter, but it does help. And the last one, Andy, I want to come on to is trusselltrust.org, and that is the food bank to you and I. And if you go onto their website, there's a Get Involved tab again, and you can make donations to the food bank. And I know this kind of links very neatly to a podcast I think we did 2, 3, 4 weeks ago, where we talked about the reverse advent calendar idea, where people were instead of having an advent calendar where they were just taking things from themselves like a chocolate, they created the alternative where they had a box and were putting an item in for each day of the month of sort of for Advent, and then at the end of that period, 24 days, they took it to a food bank. So if you haven't done that, this is just a very easy way you can make a donation. And you can make, for lots of these charities, you can make corporate donations. So if you run a company, you can make a corporate donation, be a sponsor. So there we go, charitable gifts.
Okay, lovely stuff. Well, on to the final piece now, and it's something that's been inspired by your fantastic 80/20 investor service. I suppose probably worth doing before we go into that, Damien. We'll play the advert. Here we go.
Before we move on, Andy, I just wanted to quickly mention 80/20 Investor. Now, 80/20 Investor is my DIY investment service. Do go and check it out. I empower and teach people how to invest their own money. The service provides data-driven fund tables. The data is driven by my own unique 80/20 Investor algorithm, which I created. You also get stop-loss alerts, you get research articles and insight, you get market commentaries, monthly commentaries and DIY investment lessons, but you also get access to my £50,000 portfolio, which is a portfolio of my own money, which I run live on the site for members to see, and it shows people how I use the service to maximise my returns. And in the first 2 years of doing so, I turned £50,000 into £59,500, which is a 19% return, beating investment managers, professional fund managers, financial advisors, investment banks, passive trackers and the market. So everybody can have a free 30-day trial of 80/20 Investor, and you can claim that by going to moneytothemasses.com and going and clicking on the 80/20 Investor hyperlink at the top of the page. So go and try the service. Let me know what you think of it, and I know from the feedback that you're going to love it. But for now, on with the show.
So, Damien, tech stocks. What are we talking about?
Right, so tech stocks, Andy. Now, this is something to do with technology stocks. So, like Facebook, Apple and things like that. Now, in a recent podcast, I did a piece about how it's important to try and look at things and try and understand why they happen. So we did an example then about performance tables, about being at the top or bottom, and it can tell you a story about what's going on in markets. And if you can spark that sort of inquisitive nature in people, then they will sort of run with it and try and find out other things. You become intrigued by it. It's basically making life a puzzle. That's the best way to teach people about money or anything in life, and that's just not my view. That's things I've read, and it does work. So one of the things I wanted to just try and spark people's interest in is technology stocks have had an absolute mega run in the last 12 months, and now technology stocks are up, I've got the figures to hand, but you're talking up 20% in a year, and things like Facebook and that have been flying. And part of that reason is because they've been printing money left, right and centre. If you see how much money Facebook makes in a quarter, it sort of makes your eyes water. But we've had a couple of bouts of mini sell-offs in technology stocks. So they've actually dipped, and that started to pull the stock market a little bit lower, because actually technology stocks that have done all the heavy lifting and driven the market upwards. So when you look at some of the indices out there, the likes of Facebook and that and Apple make up a disproportionate amount of an index. So they actually are pushing the market up. So if they start to fall, that starts to obviously be of concern, because if they lead the market up, they could lead it down. Now, I just want to talk about why we had a recent blip where the stocks fell very sharply in the space of a few days. And when I say sharply, they were down a couple of percent, mate, at tops in a few days, which actually sounds a lot, but it's not. It's barely anything given the rally they've had. But people started to sound some alarms. Now, one of the reasons is that they're very expensive. Now, if you do something called price to earnings, which is looking at how much you pay for a stock versus how much money they make, and you can do that in different ways. Look at the future earning potential or past earning potential. Basically, you get a number, and that number can be compared to historical occasions and give you an idea of how expensive something is. And they are as expensive as they pretty much have ever been. Going back towards the .com crash and before. So there were alarm bells ringing that this thing needed a bit of a breather. And what happened is Donald Trump came along and decided that he was going to create a new tax reform. And it hasn't happened just yet, but it's looking like it will do. And one of the reasons that technology stocks then suddenly took a battering was because the tax reforms would favour those companies out there that actually pay a lot of tax. And interestingly, that's financial companies and it's some of the utility companies, but it's not technology companies, because you know what they're like. They're very shrewd. They'd like to do a bit of offshoring and making sure they don't pay any tax. So when they've got a tax bill that's going to come along, the US tax reforms, when they come along, the companies most likely to benefit and therefore be more profitable because they pay less tax were some of the companies had been left behind in this rally. And so people were therefore thinking, let's take some profits in technology stocks and pump it into the things like banks and utility companies. And so therefore what happened, it was something called rotation, where the tech stocks started to tumble, but other areas of the stock market, particularly in the US, they either held up or rallied. And that was really interesting because that's an unusual thing to happen, but it also can be a sign it's actually a healthy market still, because the market people weren't pulling their money out of the market, running in fear because of and cashing in their chips, as it were, for the technology stocks and sitting on cash. They were just buying different types of shares. So that can actually be quite healthy for what has been an incredible bull market already, because it shows people aren't ready to quit just yet. They're just trying to be slightly more selective. And so that's probably going to be what happens going forward, that we're going to have to be more selective, or the fund managers are, about the sort of stocks they pick. And the other thing I just wanted to throw out there so people might find interesting about the way these different dynamics of different sectors, so tech stocks, for example, financials, can vary, is that in an environment going forward, we're getting to the point now where banks, central banks, so the US Federal Reserve, whether it's the Bank of England, are going to look like they're going to start raising rates, and the rates will go up, and the economies, especially in the US, are looking quite healthy. Now, interestingly enough, that's not great for technology stocks. And the reason it's not deemed great is because technology stocks, they have a lot of their earnings way off into the future because of their value. They're growth stocks, so what that means is they reinvest all their money into being bigger and bigger and bigger and making new products and doing new things. So what happens, the big payday in a way is off in the future. Now, if the economy's booming, that means interest rates have to go up because inflation starts to go up. So they raise interest rates, the central banks, to calm down inflation. Goes back to that car analogy I always talk about. And so if they do that, then when you do something called discounting, so you look at something in the future and you work out how much it's worth in today's money, you actually have to work back, basically factor in interest rates and inflation. It makes those future earnings not look as impressive. And that means, therefore, if you're going to do that whole thing about, well, how much am I going to pay for a company? When you choose a price of a company, or when the market does, they are in a way factor in as well as a supply and demand, the element of how much money the company is going to make and how attractive that is. So that means that it's not so good for technology stocks. So people start to sell them, or less inclined to buy them as heavily if it looks like the economy is going to go up, because technology stocks can seemingly make money in all sort of conditions. They aren't intrinsically linked to the health of the economy. And the other thing that's been quite interesting about technology stocks is that Donald Trump, when he came to power, is really anti them. When he was on the campaign rally before the election, he was going on about how he was going to go after Silicon Valley and make them pay tax and all this kind of stuff. So you would think that when he came to power, technology stocks would be sort of fall through the floor because they were in the firing line of Donald Trump's tweets. or his latest whim. But the fact that they then rallied could also be seen as an indicator that the market just thinks Trump is full of hot air and doesn't really believe what he's saying. Now, since the tax reforms have started to look likely to happen, that's where that started to cool off, and technology stocks have become less popular and other areas have become more popular. And it comes back to this thing called the Trump trade, which we talked about previously. But that was just a quick piece on technology stocks. I think it's just an interesting thing to how all these dynamics, whether it's interest rates, whether it's central banks, whether it's Donald Trump's tweets, whether it's price to earnings, all these things matter, and they can impact what people buy, and also how this bull market, how it could actually be that just because they start to fall down, these technology stocks, it doesn't automatically have to mean that the rally we've seen is over. Obviously, if it really goes crazy and goes downwards, then you would set off a few alarm bells. But there you go, Andy. I think that's it on the investment front. But before the slightly separate note, Bitcoin, I kind of half mentioned it last week. If anybody wants me to talk about it again, because a lot's happened in the world of Bitcoin, I almost did a piece on it, but I thought, I don't want to fan the flames of Bitcoin by keep talking about it all the time. But there are things that are interesting about it. So if you want me to talk about some of the more stuff about Bitcoin, then in passing, then do tweet in, because I will talk about it. Because one of the things is there are now a futures market in America, which makes it a bit easier to kind of bet on the price of Bitcoin, but with that money being turned back into cash rather than having to own Bitcoin. So I could come on to that, but there's lots of interesting things going on in the world of Bitcoin, not just the price of it going through the roof, but there you go. I mean, I'm going to get my hair cut tomorrow. I'm convinced. I will tell you, Andy, whether he mentions Bitcoin. It's my bubble indicator. And I'm convinced, because everybody else talks about Bitcoin. And anecdotally, there are some behaviours out there that I'm hearing about people cashing in lots of investments, chasing after Bitcoin because they think it's easy money. And it does worry me, because in a year where if you've invested wisely, you could have got 20% on equities, which is absolutely stellar for a return. I mean, looking at the average long term is sort of 5 to 6%. People are now thinking if you're not making 20-30% in a day, then like on Bitcoin, then it's a waste of time. And what are you doing sort of with their money? And I think that's a worrying place to be. But anyway, it's an interesting story.
It is. I suppose what is a positive on that is it is getting people talking about investing. But like you say, whether that's healthy or not because of the inflated sort of percentages they're looking at. I even had a call just a couple of days ago from a friend of mine that I haven't chatted in a while, and he knows that we do this podcast, and he wanted to talk about Bitcoin and what were my thoughts. So I suppose that's one in the camp of yes please, Damien, for talking about Bitcoin next week. But do tweet Damien, let him know if you want to talk about Bitcoin in upcoming podcast. We're going to have definitely one more before Christmas, aren't we?
Yeah, I think we'll definitely have one more. Andy and I will have a 1 week break, obviously over Christmas, and so we will do one next week. So if you want one, send in some questions about Bitcoin.
Good stuff. Get in touch in the usual way at Money to the Masses with the number 2. That'll get straight through to Damien. You can email us if you've got something slightly longer that you want to ask. It's podcast@moneytothemasses.com. Obviously, any feedback that you want to give us, send it that way, and review the podcast if you can. Go onto iTunes and let us know what you think about it. Give us a 5-star review. We'll be very appreciative. Until next week, Damien.
Till next week.
Don't forget to claim your free copy of Damien's best-selling book, The 30-Day Money Plan. Sort your finances in just 5 minutes a day, worth $4.99. Just go to moneytothemasses.com/podcast to find out how.